Hi everyone, welcome to this session. In this session, I will be solving some problems from our problem set for the course entitled Financial Management 1. Let's get started. All right, here the first problem here about the balance sheet, how to construct a balance sheet. So it says construct a balance sheet for a company given the following data. What is the shareholders' equity? So probably shareholders' equity is the missing values for the balance sheet we are going to construct. So let's construct the balance sheet here. So here we go. So on the right-hand side, we split this part into three parts here. So here we're going to be current liabilities. Here non-current liabilities, and here the equity side. And this is the side which is asked shareholders' equity. This is going to be the question mark. Left-hand side will be split into two parts, current asset and non-current or fixed asset. So the sum of this will be equal to total asset. And here going to be total equity and liability. So let's plug the figures into this chart. So current asset, cash balances will be current asset, which is 10,000. Inventory will be current asset 200. Store and property, which is fixed asset 100,000. And account receivable, which is the current asset 22,000. Account payable, which is current liability 17,000. Long-term debt here 170,000. So that's it. As you see, the sum of asset will be equal to sum of total equity and liabilities. This is going to be a question mark, which is X. You sum this part, and I'm going to write this 10,000 plus 200,000 plus 22,000, which should be equal to plus these other figures 100,000. This should be equal to 17,000 plus 170,000 plus X. So if you sum left-hand side and right-hand side and leave X alone, you will find equity values. So this is for you. That's it for this problem. The second problem is about the tax problem. Here we do have some income levels, and based on these income levels, we have here a schedule for single taxpayer and married taxpayer. So the question is calculate the marginal and average tax rates for a single taxpayer. That means I'm going to consider this part here in order to calculate A, B, C, D. So I will choose B for a representative solution because the rest will be the same for the others. So if my income is 50,000, and now I'm going to calculate a marginal tax rate per each threshold here, and then I will calculate average tax rate. So how I'm going to do that? First of all, the shortcut solution might be 50,000 will be somewhere at the third rank here, 50,000. So till that part, I'm going to just reverse the number. So which means $8,025 minus 0. I will multiply this by the tax rate at this rank, which is 10%, 0.10. So I'm going to write the result here. And then for the next one here, again, I will reverse the number 22,550 minus, here we go, I'm writing from here. I will deduct $8,025 because it is already taxed by 10%. So the remaining part will be taxed by here 15%, 0.15. So you write here again the amount of tax you calculate over this multiplication. The last part where your income fill in here. So it's going to be now the upper threshold will be not 78,850, but your income level, which is 50,000, minus here the previous rank higher threshold, which is 22,550. So this will be multiplied by 25% tax rate. Here you go. So then you calculate each of these tax amount, such as if this is, for example, X, Y, Z. Each of this is a marginal tax rate, but here the marginal tax rate, for example, for this income level would be 25%, which might be considered as marginal tax rate. Marginal tax rate. On the other hand, what is the average tax rate? All you need to do is you need to sum all the tax amount you paid, which is X plus Y plus Z, and then divide this amount to your income level, your income, which is X plus Y plus Z. You will sum them up and then divide by 50,000. This is going to be average tax rate. That's it. Next one. So we have a company over here. A company discovered a way to turn lead into gold and patented this new technology. He then formed a corporation and invested $200,000 in setting up a production plant. He believes that he could sell his patent for $50 million. So the question is, what are the book value and market value of the firm? So book value is, simply speaking, the balance sheet shareholders equity, which here the equity, as you see what it says, they spent $200,000 over here, where in plant and equipment. So probably here the fixed asset here, they invest $200,000 as an equity, and then this amount will be spent here, $200,000. So for this reason, so at this point, we don't need to write or indicate liabilities or current assets. We don't need that one. So the sum of this will be equal to, this is going to be total asset, and this is going to be total equity and liability. So as we learned before, book value of a company is equals to shareholders' equity. Shareholders' equity, which is $200,000. So what about market value? Here, the market value of the firm. Market value will be equal to now book value plus estimated market value of the patent. So this is going to be value of patent, which means $200,000 plus 50 million. From this point, we might write $50.2 million as a market value. The second part of the question, if we assume if this is A and this is B, if there are 2 million shares, what is book value per share and market value per share? So book value per share will be, simply speaking, $200,000, which is the book value, divided by 2 million. This is going to be book value per share, and the market value per share will be 50,200,000 dollar divided by 2 million, and this is going to be answer for market value per share, and this is the book value per share. So that's it. Next one. Again, we have a question, a problem about income statements. So it asks us what are earnings before interest and taxes, net income, and cash flow from operations, which requires to construct income statement. So let's construct. Here we go. So net income, net sales will be here. Sales is $10,000 minus cost of goods sold. Do we have cost of goods sold? Here we go, 6,500. This is going to be equal to gross profit or gross income, 3,500. Then I should deduct some cost. So general and administrative expense. General administrative expense is 1 million, and minus depreciation, which is, do we have depreciation expense? Yes, here 1 million, another 1 million. So this is going to be earning before interest and taxes. So minus figures, so it's going to be 1,500. So I need to deduct now interest cost, interest expense, which is 500. And then this is going to be earning before taxes, which is 1 million, if I didn't make any mistakes here. And then tax rate is 35%, so taxes at 35% will be 350. So it's going to be net income. So net income will be 650. And if I add depreciation here, depreciation, which is not cost, cash outflow, this is going to be equal to cash flow from operation. That means here it's going to be 650 plus depreciation, where it is here, 1,000. So it's going to be 1,650. If I didn't make any mistakes here, it's going to be cash flow from operations. So this result will be cash flow from operation. This is net income, and this is earning before interest and taxes for this question. That's it. So next one, another income statement problem. Again, I need to construct income statement. Let's do it. Net sales will be, do I know net sales? No, I do not. So I will leave empty. Minus cost of goods sold, which is 8,000. And then this is going to be gross income. And again, I don't know. I subtract, what cost do I know here? Income, taxes, administrative expense, depreciation. Here, administrative expense will be 3,000 minus depreciation, which is 1,000. this is going to be equal to earning before interest and tax, which is unknown at the moment. And from this one, I will deduct interest expense. What it is here, 1,000. And this should be equal to earning before taxes, earning before tax, which is unknown at the moment, and the taxes paid, where it is here, 2,000, and this should be equals to, my dear friend, net income, which is unknown. Okay. What is given, by the way? Tax rate is 20%. So now I have a clue here. So 20% tax rate, if 20% is equals to 2,000, then what might be earning before interest and taxes here? So it's going to be calculated as 2,000 divided by 0.20. From this point forward, I think it's 10,000, which means if earning before interest and tax is 10,000, if this is 10,000, then 20% of this will be 2,000. So this is correct. So then net income will be 8,000. All right, so let's go back forward. So if this is earning before interest and tax 10,000, what will be earning before interest and taxes? So I deduct 1,000, this is supposed to be 11,000. Similarly, if I add this up, 3,000, 1,000, it's going to be 15,000 here. So from 15,000, if you deduct 4,000, you will get 11,000. Similarly, for net sales, it's going to be 23,000. If you sum 8 and 15,000 add up, then you will get 23,000. That's it. So what is the question? Net income is over there, net income A. What must happen? The revenue is over there, here, and earning before and taxes over there. So you solve the problem. Next one. Okay, so we have a company had 14 million in sales last year. Cost of goods sold was 8 million. Depreciation expense was 2 million. Interest payment on outstanding debt was 1 million. And the firm's tax rate was 25%. So it asks me again net income, net cash flow. I will calculate this. I will construct net income. Net sales will be, what it is? 14 million. Okay, cost of minus cost of goods sold will be 8 million. And this is going to be equals to gross income, which is 6 million. Then I will deduct what I have as a cost, depreciation expense. Do I have administrative expense? No, I just have depreciation expense, which is 2 million, right? Yes, 2 million. And then this is going to be earning before interest and tax, which is 4 million. And then I do have interest expense, which is 1 million, minus interest expense 1 million. This is going to be earning before taxes, which is 3 million. And then I need to calculate taxes. So taxes will be calculated based on 35%. So this is going to be 1.05 million. And this is equals to net income, which is 1.95 million. So for A here, net income I calculated, and cash flow, you should add depreciation back. Depreciation, which is 1 million, not 2 million. So the result will be 3.95 million, which is net cash flow. All right, this is A. Now for part B over here, let me read. What would happen to net income and cash flow, which means this and this, if depreciation were increased by 1 million, which means depreciation over there, if this is increased from 2 million to 3 million, what will happen to the result? Well, all you do, you will rewrite this and change 2 with 3 and then calculate this, do the same calculation. That's it. For part C here, would you expect the change in income and cash flow to have positive or negative impact on the firm stock prices? What it says, would you expect the change in income and cash flow to have a positive or negative impact on the firm's stock price? Of course, these two figures has positive relationship with the stock prices. If those figures increases, then stock prices should increase as well. So now for the D here, consider the impact on net income and cash flow if the firm's interest expense were 1 million higher. Why is this case different from part B? Now you will change interest here from 1 million to 2 million, then calculate again net income and depreciation and evaluate the result. That's it. I mean, for part A, B, and D, you will reconstruct this income statement with the required revisions. That's it. I'm not going to do that. This is your task. Good luck. Next one. So here we have a balance sheet, my dear friend. And what is the A? What was the owner's equity at the end of 2008 and 9? As you see, when you look at this balance sheet, the missing part is equity side here. Equity is not given, my dear friend. So remember from the first accounting identity, will be total assets will be equal to total liabilities and equity. So total asset is for 2008 and 2009, I need to calculate independently, differently. So for 2008, total asset is sum of these two. Let me write here for 2008, total asset is 1,200 plus 310, which is equals to this one, sum of this 210 plus 830 plus equity. So from this, you will calculate equity here. And for 2009, you will do the same. 1,420 plus 420. And this should be equal to this one, 240 plus 920 plus equity. So from this simple equation, then you'll leave equity alone and solve it. So then B, it says, if Noble paid dividends of 100 in 2009 and make no dividend issues, what must have been net income during the year? So we need to calculate these two figures. Let's do it. This is going to be from this one, 1,510 should be equals to 1,040 plus equity. And from this, it's going to be 470 is the equity. So equity here is 470. And for this year, if you sum this up, it will be 1,840 plus this is going to be 1,160. It should be equal to 1,160 plus equity. Okay, so what might be 1,840 minus 1,160? It's going to be 680, which is equity in 2009. So this is going to be 680. Now the question is here, it says, remember net income is equals to dividend paid plus retained earnings. So dividend is 100 and it asked me the retained earnings. So retained earnings is the amount of net income which is kept in the company where in shareholders' equity. So retained earnings can be found as follows. This is changes in equity. What do I mean? So what is the difference between these two figures? It's going to be 680 minus 470, 210. So that means this is retained earnings here, 210, the net income, 310 then. So this is B, A. And C, if the noble purchased 300 in fixed asset during the year, what must have been the depreciation charge on the income statement? Well, look at now the fixed asset over here, the change in the fixed asset. So change in the fixed asset will be 1,420 minus 1,200, which is 220. And this is, as you see, net fixed asset. So this is the net fixed asset. But how much spent? 300 is spent. So difference between 300 minus 220, which is 80, this is the depreciation. Okay, D, what was the change in net working capital in 2008 and 2009? So, well, net working capital, remember, it is net working is the difference between current asset minus current liabilities. So it's very easy to calculate. Please calculate by yourself. So for 2008, current asset is 310 minus for 210. This is current liability in 2008. So this is going to be net working capital in 2008. Okay. So what is the result? Which is 100. Again, you will calculate this for 2009. Well, if I calculate for you, 420 minus 240, which is 180. And then the last step is take the difference. In 2009, you have 180, and in 2008, you have 100 net working capital. So 80 is the answer for part D. Last one, if the issued 200 of new long-term debt, how much debt must have been paid off during the year? Again, look at now the long-term debt figures, how much it is increased. It is increased from 830 to 920. So how much is increased? Which is 90. Okay, that's cool. How much debt rise? 200. 200 is raised, however, 90 is still existed. That means 200 minus 90 is paid off, 110 is paid off. All right, that's it. Or for this type of problem, I'm not going to go to detail. It's very, very easy because you are going to have formula formula, and then all you need is to plug the figures into the formula. For example, long-term debt ratio, long-term debt ratio will be long-term debt to total asset. Okay. If ratio is given as it is, then go and look at total. Here in this figure we have end of the year and start of the year. If you have these types of ratio, go and use end of the year figures. So what is total asset? So total liabilities and equities also equals to total asset here, 27,503. What is long-term debt? Look at the long-term debt over there here, where it is long-term here. Long-term debt is 7,018. That's it, my dear friend. I'm not going to go to details. It's so easy. So please do by yourself. Next one. In this question, one missing point we have. It says if the market value of Phone Corporation stock, which is here, Phone Corporation, this is the Phone Corporation, as you see, what it says, market value will be $17.2 billion. All right. Okay. What was the market to book ratio? Market value to book value, market to book ratio. So $17.2 billion. So what is the book value? Go and check balance sheet and see the shareholders equity, which is 9.724 billion. 9 point, please don't forget this point, $724 billion. So you will divide 17 by 9, okay? So this is going to be market value book value ratio. So what else it says? If there were 205 million shares outstanding, what were earnings per share? So earnings per share is net income divided by number of shares. So which means net income. Which net income here? It's not given in the problem. It's given in here in the previous problem. So net income, here we go, 1.311 billion. Where it is $1.311 billion divided by 0.205 billion shares. So if you do this calculation, you will find the solution. Okay, next one. Well, one remark. If this types of question is asked, all figures will be given in the problem, don't worry. Another question here. A firm has a long-term debt ratio, long-term debt, which is long-term debt to total asset. This is going to be what? 0.4. And shareholders' equity is 1 million. Equity is $1 million. And current asset is $200,000. And current ratio here, the current ratio, which is current assets divided by current liabilities. How many? It is 2. It's 2. And the only current liabilities are notes payable. What is the total debt ratio? Okay, my dear friend, let's construct the balance sheet here. Okay, so current asset, what is current asset? Current asset is here. Let's write it with the red one. Current asset here, which is 200,000. And current liabilities here, which is half of the current asset, because if current asset is 200, then the current liabilities will be 100. So this is current liabilities, which is 100,000. Here, long-term debt to total asset, and also we have equity. Equity is here. Equity is $1 million. Here we do have the only current liabilities are not payable. All right. Sorry, here I made a mistake. This is debt to equity. This is debt. This is not asset, equity. So that means if equity is 1 million here, total debt will be 400,000. So this is long-term debt, which is 400. Okay, so we calculate total asset now, 1,500,000, I guess. 1,500,000. Okay, this is equals to total asset. So what is asked is total debt ratio. Total debt ratio will be total debt to total asset. So that's it, I found it. Total debt is 500 divided by total asset, which is 1.5 million. Okay, that's it. Last one, I guess, yes. A firm has a debt to equity. Debt to equity is 0.5, and market to book value, book value is 2. So what is the ratio of the book value of debt to the market value of equity? Okay, let's plug some figures here. This is debt to equity, and equity here should be considered as, remember, book value is the equity. So debt to book value, which is 0.5. So if I say book value is 100, okay? So if book value is 100, that would be 550. So remember, this is debt, this is book value. So if you construct the balance sheet here, this is debt, equity. So if here is 100, this is going to be 50. So total asset will be debt plus equity, which is 150. All right. So what is the market value then? If book value is 100, market value will be 200. So now, what is the question? The question is book value of debt, book value of debt, which is here 50, divided by the market value of equity. The market value of equity, which is here 200, market value of equity, which is 200, which is 1.4. That's it. That's the end of the selected problems. I wish you good luck in the exam.